Short exercise 5-9. We're going to prepare a merchandiser's statement of owner's equity and then the balance sheet. So Carissa Communications reported the following figures from its adjusted trial balance for the first year of business, which ended on July 1st, 2016. So here are some accounts, or here are her accounts in random order. And then here's her income statement. We don't need the income statement quite yet. Let's read the rest of this. So we're going to prepare Carissa Communications statement of owner's equity for the year ended July 31st. Assume that there were no additional contributions or withdrawals during the year, and the business began on August 1st, 2015. So let's review our financial statement formulas. So the financial statements are done income statement first, revenue minus expense gives us net income. Then we use the net income in the statement of owner's equity. Statement of owner's equity is just going to show us what has happened to capital. So we start with beginning capital. We add any investments. Investments are also known as contributions, owner contributions. We add net income or subtract a net loss. We subtract any draws, and that gives us our ending capital. And then we do our balance sheet, and that's based on the accounting equation formula, assets equals liabilities and owner's equity. In this case, the equity we need to use is the equity or capital at the end of the year, not the beginning of the period. So we're going to first do the statement of owner's equity. So we need beginning capital plus investments plus net income minus draw equals ending capital. Exclude any zero balance events from the period, from the statement of owner's equity. So in other words, if the company has no investments or contributions, leave it off. If the company has no draws, leave it off. So we're going to start with the statement of owner's equity. We need Carissa Capital's August 1st capital account balance. And we get that right here, August 1st, 2015. So it's 2820. Copy and paste. And getting back to our formula, we would then add investments or contributions, owner contributions, but the problem said that there are no contributions, so we skip that. We go down to net income. Net income comes from the income statement. So we need to open up the income statement. And the bottom line of the income statement was $70.80, so $7,080 net income. Paste that here, and that is our net income for the year. And we're going to add this up. We get $9,900 for capital at the end of the period. Check our answer. Good job. Next, we're going to move on to the balance sheet. The balance sheet, of course, is based on the accounting equation, assets equals liabilities plus ending capital. So we're going to start with the asset section. And remember now, we're doing a classified balance sheet per the instructions, classified balance sheet. Use the report format. The report format just means assets are going to be on top, followed by liabilities and equity on the bottom, as opposed to being on side by side. So our first category of assets is called current assets. These are assets that we expect to be used up within the next year. So let's just start right from here and see if we can find any current assets. $4,100, cash is a current asset. Next, we got selling expenses. That's an expense, not an asset. AP is liability. Capital is capital. Notes payables, liability. Inventory. Here we go. We got $1,200 of inventory. So this is what's going to be different about a merchandiser's balance sheet is they're going to have this new account called merchandise inventory. And of course, what that is that's the cost of the inventory. And by cost, when we say cost, we mean cost to this company, not to the consumer that they hope to sell it to. Let's go back to our chart of accounts or our list of accounts, see if we have any other current assets. We got an expense. This is a contra revenue. COGS is an expense. Equipment net equipment or equipment net, that is a long-term or a fixed asset, so that's not a current asset. Accrued liabilities, liability, revenue. Here we go, AR. We've got $3,400 of accounts receivable. AR. Traditionally, AR would be listed second, but my accounting lab does not enforce the order. They're just happy if you get current assets in the current asset section. See, do we have any other current assets? That's an expense, and sales discount is a contra revenue. So we're going to add these up, leave this line blank since there are none, or are no more. So we're going to add 4,100 plus 1,200 plus 3,400 gives us $8,700 of current assets. Total current assets. Scroll down. And notice we have another label. The next label will be the long-term assets, but no one calls them that. They call them property, plant, and equipment, or plant assets. So let's look through our list of accounts, see if we have any assets that are long-term. The only one I see is this equipment. The net, if you're wondering what that means net, or after accumulated depreciation has been subtracted from the cost of that equipment. And that's our only plant asset. So that gives us total plant assets of 8,500. Scroll down, and now what we're going to do, let me close this so it's easier to see. Now we're going to add up our total assets. So to find total assets, let me put in the label. We're going to add up our current assets of 8,700 plus our plant assets of 8,500 gives us $17,200 of total assets. Now you may be wondering why we have two different columns. Notice this does not say debit, this does not say credit. So don't be thinking that these are debits and credit columns. In a balance sheet, you get to choose however you want to format it. So what this company has done is they put the main numbers over here in the far right column. The main numbers that people are interested in are total assets, followed by the plant assets and current assets. Then if someone was wondering, well, what do our current assets, or what are our current assets comprised of, then they can go over here to this section, this column, which is just a breakout of our total current assets. So the more important numbers are on the far right, and then the detail is in the left column. Fantastic. Now we're going to go to our liabilities. Again, we're just following this formula, assets equals liabilities plus ending capital. That's the balance sheet formula. So we're going to start off with current liabilities, and then the next section will be our long-term liabilities. We need our account balances again. So let's start up here with cash and work our way down until we find a liability, a current liability, $4,900. Oops. AP is definitely in a current liability. Definition of a current liability is something that you expect to pay within the next 12 months. See if we have any other liability or current liabilities. We've got accrued liabilities. Accrued means it's accumulated but not yet paid. The most common example of this would be wages or salaries payable. We got $2,000 of accrued liabilities. Could also include taxes payable. And I don't see any other current liabilities. So we're going to add these up and put the label of total current liabilities, and that is $6,900 of current liabilities. Now we're going to look for the long-term liability, and the only one I see is this long-term or note payable, the long-term portion of the note payable, $400. And then notice what we're doing here is we're going to be adding this number, current liabilities, plus the long-term liabilities. So that means we're going to get total liabilities here. They don't have a line for total or long-term liabilities. I did forget this. Let's see here. What is this? This is note payable long-term. So again, the reason you know that this is total liabilities and not total long-term liabilities is this column has us adding the $6,900 plus the $400 gives us $7,300. Going back to our cheat sheet, the balance sheet formula is assets equals liabilities plus ending capital. So we can't use this capital here because this is the capital at the beginning of the period. Remember, this balance sheet is for 2016. So we need ending capital. Where do we get the ending capital from? Well, we already calculated it up here. Right here. Ending capital at the end of July 31st, we got $9,900. And that is Carissa, capital. And then what we're going to do is we're just following our formula. We're going to take liabilities plus that ending capital. So we're going to add those two together, and that gives us $17,200 of liabilities and owner's equity. Now, before you hit submit, you should double check. Does our balance sheet equation balance? Do assets equals liabilities plus ending capital? In other words, liabilities and ending capital is $17,200. That should be the same as our total assets, which was $17,200. So our balance sheet does balance. And that's it.